Three, two, one. Welcome to the show.
Welcome to the show.
This is the first time we've done this actually on a Sunday in a long time.
Yeah. Yep, it's been a while. It's been a busy weekend.
It has, man. Snowed here, so it kind of put a little wrench in our plans to record early.
Yep.
What do you got for us this week, man?
It's going to be a busy week this week, and I'm going to try to make this show as simplistic on a very nerdy topic as I can, right? So this week, the Fed is going to raise rates, right? We've been talking about it since, well, it's been all over the media since January 6th when the Fed came out and said they were going to start raising rates a series of times in 2022. So I kind of think not a lot of people really understand what that means. And so I found a really good article we're going to kind of go through that explains what that is. And that's going to be kind of the focus of the show. So what we're going to do, what actually happens when the Fed raises interest rates, then we'll look at long-term TSP Fund Charts with support and resistance levels. I'm going to do DFEN again as the bonus chart. We did it last week, and I wanted to show what happened over the course of the last week or so. And then the 2-year weekly charts. Okay. So what happens exactly when the Fed raises interest rates? So, like I said, I got this article from Forbes.com down here. It's a really good kind of basic article that explains what happens when Fed raises rates. So job number one for the Fed is managing monetary policy for the United States, right? So it controls the supply of money in the economy. The Fed has other tools, right? Quantitative easing and some other things that it can use, but its ability to influence interest rates is the most prominent and effective monetary policy tool, right? That's the main tool that the Fed has. So when people talk about Fed raising rates, they're referring to the federal funds rate. At the FOMC meetings, which is going to happen this week, March 15th and 16th, right, is the next FOMC meeting, they set a target range for the federal funds rate. And so the target range acts as kind of a reference point for interest rates that big commercial banks charge each other for overnight loans. So that's what that is. When the Fed raises and lowers rates, it's specifically making it more or less expensive for big commercial banks to charge each other for overnight loans. Okay, so that's the basis of it. And then what trickles down from there is really what we're going to talk about going forward. So banks borrow overnight loans to satisfy liquidity requirements set by regulators. The average of the rates banks negotiate for overnight loans is the effective federal funds rate. And it impacts other market rates, right? It says here like the prime rate and the SOFR. Could be LIBOR. There's all kinds of different bank rates. Ultimately, those rates affect credit card rates and mortgage rates and things that actually apply to the normal people like us. Thanks to this somewhat indirect arrangement, the Fed funds rate is the most important benchmark for interest rates in the U.S. economy, influences interest rates throughout the global economy as a whole. Okay, so for a little bit of reference, the prime rate right now is 3.25%. And it's the rate that banks charge their best customers for personal loans, credit cards, auto loans, those kinds of things. Okay, so what happens when the Fed raises rates? When the Fed raises the federal funds target rate, the goal is to increase the cost of credit throughout the economy. So increase the cost of credit. It means it increases the cost to borrow money. Okay, so when the Fed raises rates, it's increasing the cost of big banks, the amount of money that it costs big banks to loan each other money overnight, right? That's where it starts, and then it trickles down. So higher interest rates make loans more expensive for both businesses and consumers, and everyone ends up spending more money on interest payments. So if you can't or don't want to afford higher interest payments, you postpone projects that involve financing, right? You don't borrow so much money. And it doesn't matter if it's an individual or a company. It simultaneously encourages people to save money to earn higher interest payments and reduces the supply of money in circulation, which tends to lower inflation. So that's why if you reduce the amount of money in circulation, it lowers inflation, which, they call it cooling off the economy. That's why right now, because inflation is so high and increasing, that's why you hear all this talk about the Fed wanting to increase rates, because it reduces inflation. And we're going to come back to this one about it encourages people to save money, because as the Fed increases rates, the savings rate gets higher. So the more money you have in savings, the more interest you're earning on those dollars in savings, which for us is the G fund. All right. So if we look at an example of a mortgage, right? Like I said, the Fed funds rate doesn't affect mortgage rates directly, but in this example, they use it as if it applied directly. So you take a family shopping for a $300,000 30-year fixed rate mortgage. If they could get a rate at 3.5%, then the total lifetime of the mortgage on that $300,000 is $485, right? And so out of that $485, $185,000 is interest payments at 3.5%, right? And that makes your monthly mortgage $1,340. So what happens if the Fed raises rates by 1%, right? You still are trying to buy a $300,000 house. So now your interest rate went to 4.5% rather than 3.5%, right? So over the 30 years of that loan, you're paying $547 instead of $485, right? So now you're paying $247,000 in interest. And most importantly, for us from a day-to-day perspective, your monthly payment went from $1,340 to $1,520. Okay. So at the end of the day, when you're shopping for a house, that's kind of one of the most important things, right? How much can you afford to pay monthly on the mortgage? And the more it costs you in interest, the less you can spend for the principal of the house. So they don't do it in the example, but if you could only afford $1,340 for a monthly mortgage payment, back here you could buy a $300,000 house. But if the Fed raises rates, you can't buy that $300,000 house anymore, because now it costs you $1,520 a month. So maybe you're buying a $250,000 house. So obviously it drives down price of real estate. So in response to this increase, the family in this example might delay purchase of a home, opt for one that requires a smaller mortgage to minimize their size of their monthly payment. This is a very simplified example, but it shows how the Fed reduces the amount of money in the economy when it raises rates. So besides mortgages, raising interest rates impacts stock and bond markets, credit cards, personal loans, student loans, anything that you need to borrow to buy. So for our purposes, right, the impact on stocks, and for us that's the TSP stock funds. So higher market interest rates can have a negative impact, not always, can have a negative impact on the stock market. When Fed rate hikes make borrowing money more expensive, the cost of doing business rises for public and private companies. Seems obvious, right? Companies need to borrow money to grow and expand, and the more your business model is based on using borrowed money, the bigger the effect of Fed raising rates. So over time, higher costs and less business would mean lower revenue and earnings for public firms, potentially impacting their growth rate and their stock values. So if the cost of borrowing money from a bank increases, the opportunity to expand investment in capital goods by a corporation stalls. And it's interesting that this quote comes from a Silicon Valley investor, former pre-IPO employee at PayPal. The interest rate may be so high that many companies will not be able to afford to grow. So we've seen over the past, since January 6th, tech really taking the hit in this current correction that we're in. And we've talked about it, but he refers to it here in this quote, and it's a Silicon Valley guy. So the tech companies live on borrowed money. And so they're the ones that are taking the brunt of this Fed increase in rates. So more immediate is the impact Fed rate increases have on market psychology, how investors feel about market conditions, right? When FOMC announces a rate hike, traders might quickly sell off stocks and move into more diverse investments without waiting for the long, complicated process of higher interest rates to work their way through the economy. And that's what we've seen, right? January 6th, Chairman Powell comes out and says they're going to raise rates starting in March, and they're going to raise, they're going to evaluate going forward, but they're going to do multiple raises throughout 2022. On the announcement is when the market began to tank. This week, so 3 months later almost, 2 months later, they're actually going to implement that rate increase. And we've already had this huge sell-off. So yes, traders might quickly sell off stocks and move to more defensive instruments without waiting for the long, complicated process of higher rates to actually trickle their way through the economy. So we've definitely seen that. So what's the impact on bonds? So for us, this is the F fund, right? Bonds are particularly sensitive to interest rate changes. When the Fed increases rates, the market prices of existing bonds immediately decline. That's because new bonds will soon be coming onto the market, offering investors higher interest rates. To reflect the higher overall rates, existing bonds will decline in price to make their comparatively lower interest rate payments more appealing to investors. So when the rate of return that you get on a bond increases, the face value of the bond decreases. So which is what we see in the F fund. When rates go up, the value or the price of the F fund goes down. So when prices in an economy rise, the central bank typically raises its target rate to cool down an overheating economy. Inflation also erodes the actual value of a bond's face value, which is a particular concern for longer maturity debts. So it's inflation also erodes the actual value, because just like we've been talking about, if you're in the G fund, for example, the rate of return in the G fund, while it's increasing right now, is not keeping up with inflation. And it's the same way with bonds in general. Okay, so the last thing about this is savings, which for us is the G fund. So while higher interest might be bad for borrowers, right? If you're looking to borrow money to buy a house, or you're a company and you're looking to borrow money to grow, if you're a saver, it's different. Because while higher interest rates might be bad for borrowers, they're great for anyone with a savings account. That's because the Fed funds rate is also a benchmark for deposit account annual percentage yields, right? APYs. When the FOMC raises rates, banks react by increasing the amount you earn from your deposits. That means the APYs you earn on savings accounts, checking accounts, CDs, money markets, the G fund, the rate of return you get rises, right? Typically, online savings account react more rapidly to Fed rate changes because there's much more competition among online banks for deposits. APYs offered by conventional brick and mortar banks respond much more slowly to rate increases and generally don't get very high even in the best of times. So this is basically our sort of the view of our G fund, right? G fund gets a bad rap. However, from 1988 to 1991, the annual rate of return for the G fund was in the 8% range, right? From 88 to 91, if you were in the G fund, you were getting 8% a year. From 92 to 97, you were getting in the 6 to 7% range a year. From 98 to 2002, you were getting in the 5 to 6%. From 2003 to 2008, you were getting in the 3s and 4s. And from 2009 to now, you're getting less than 3% rate of return for the G fund. And the lowest was 2020 at 0.97%. But if you recall, that was back in 2020 when rates were actually negative in Europe. So the highest rate of return that we've seen in the G fund historically was 1990 at 8.9%. So if you're in the G fund in 1990, you had no risk by statute, and you got an 8.9%.
People would kill for that now.
Oh, it's unbelievable. Yeah. Yeah. It's the G fund. It's a tool, right? It's and knowing when to use it. You obviously, when stocks are going down, you go into the G fund because you don't want to lose the value of your account. But you can definitely make money in certain time frames and market conditions in the G fund with zero risk. I mean, in like we said, the rates went negative in Europe in 2020, so there's a risk there. But the G fund, by statute, can't have a negative quarter.
Mm-hmm.
You can't, as it is right now, unless and until they change the legislation of it, you can't have a negative quarter by statute in the G fund. So I know it gets a bad rap, but it doesn't always need to. All right. Last thing about this. So if your eyes are rolling in the back of your head already, try to kind of shake it off a little bit and look at this one because it's actually pretty interesting. This is the percent of the federal funds rate, okay? So back here in 2000, the rates were pretty high, above 6%, and we're at the top of the stock market, right? The top of the tech rally. The Fed sees that the market starts to tank, right? And so the Fed reduces rates to try to stabilize the economy and kind of because now if you reduce rates, you are decreasing the amount of money that it costs to borrow, right? The amount of interest payments you're making, so companies can afford to invest more and grow more. And so as the market comes down, right? Because we bottomed to 2003. So as the stock market comes down, the Fed is trying to ease the burden by bringing rates down. At some point, the Fed sees that the market is stabilizing and the stock market starts going back up. And so as the market starts going back up, Fed starts raising rates because it doesn't want the market to get overheated, right? But the market keeps going up. And if you recall, that was the top of the housing boom, top in 2007. And then what do they call it? It was the great something. So many greats, I can't even keep track of them anymore. But financial crisis starts happening because of housing, right? So the market tanks again. Fed eases down here to the bottom in 2009. And then it does something really that people have been talking about for a long time. We had this huge crash financially that bottomed in 2009. And it was also the bottom. So stocks in 2009 started going back up, right? But the Fed didn't raise rates. It kept them between 0 and 0.25% to ease this financial collapse that we had through 2009. And it kept rates low all the way to 2016, even though the market was taken off, right? So in 16, the Fed says, all right, the economy's doing well enough. We'll start raising rates a little bit. And if you remember, what was it called? The taper tantrum, they called it. Back here in this period in 2018, the Fed was increasing rates, and eventually the market kind of went sideways and down a little bit in 18. It wasn't a huge crash. It was a bit of a correction, but it forced the Fed to stop raising rates, and they started decreasing rates again. And so when COVID happened, rates just collapsed all the way back down, right? Because for obvious reasons, they needed to get as much money into the economy as they could because nobody was going to work. So now we're in a position where rates are the Fed fund range is 0 to 0.25%, and it's been there for the last couple of years. But we've also had this gigantic explosion in stock price, right? Actually, from COVID to now, I mean, it went basically straight up, the stock market. But interest rates stayed at 0. And so the problem is, back here, when we had rates high at the top of the market, right, in 2000. We had rates lower but relatively high at the top in 2007. And now we have rates at 0 at the top in 2022. So if you've followed it at all on the news, a lot of people are saying that the Fed waited too long to raise rates, right? And that's what that means, because the stock market had been exploding higher and the Fed wasn't raising rates to try to cool off that stock market expansion. So now that we're at the top, it doesn't have it doesn't have this tool to use. It can't make rates go lower. They're already at zero. And we have this inflation problem. So, I mean, I don't know. I wouldn't want to be the Fed chairman. Their primary tool to slow down growth, they basically didn't use. And so rates are at zero. We have inflation that is going to force the Fed to raise rates, but the market is already at a high. So it's not like this, and it's not like this. So I don't know what's going to happen, but I think it's really interesting. So hopefully you guys got a little bit of something out of that. I think this chart is fascinating. Okay, but going forward to what the long-term support and resistance kind of looks like for our TSP funds. So we're going to look at 10-year weekly charts for the 4 TSP funds. All right. So here's the 10-year weekly of the C fund. The dotted line I drew, I mean, all I did was connect low here from 2012 and connect the primary lows. Okay, we had an overshoot for sure at COVID, but I just connected the primary lows all the way back to 2012. So it's basically a mean line, and this concept of a reversion to the mean. So at some point, price is going to get down here and try to find support at that level. It could be that, you know, price continues out here, and as this line comes up, it hits it out here in the future somewhere. But at some point, price should come down and hit this line somewhere, right? So we have a pretty long way to go on the C fund before that happens. The other thing we can look at is support and resistance levels. So this ought to be a support level, right? This line. Oftentimes, you can kind of see it right here. Oftentimes, the market will come back up to a prior high and either hit resistance there or break through it, and then that level becomes support. So in this case on the C fund, we had a high back here right before COVID, and then the recovery rally after COVID stalled here at that level before it moved higher. Okay, so now this level at 3,500 should become support. So as price comes down, it should find support there at 3,500, and it's also not too far above that long-term kind of mean line. So it's possible that, you know, price comes down, doesn't have to do it in one fell swoop. It can come down in a series and hit 3,500 here at that support line, right? That's one possibility. But those are the kind of areas we're looking at for long-term support in the C fund. Another thing to look at is the relative strength indicator. We are not at oversold on a weekly basis yet. When we get oversold, we tend to get support or a bounce, and we're not there yet. All right, S fund. S fund has taken a much bigger dip than the C fund has, but it's the same kind of thing. We got prior highs up here, right, between 1,500 and 1,600 on the S fund. We also had some churning back here when it tried to break through that after COVID. So it's the same kind of idea. And we have the same long-term kind of mean line, right? So does the S fund come down here, you know, do some recover, come back down, hit support somewhere around this ascending line and prior support level? It's a very good possibility, right? And if it does, then the long-term uptrend is still in place. If it doesn't get support at this line, then, you know, it's a much different conversation. We are much closer to oversold on the S fund than we are on the C fund. And so could the relative strength come back up, hit 50, roll back over, and now we're back down here at oversold again when price gets to this line? Yeah, absolutely possible. So those are the kind of the levels we're looking at long-term on the S fund. I fund, once it broke through that 75 level, we've been talking about that 75 level as really important support for a long time. And then in the last few weeks, it completely lost it. So the next area to look at here is 65, and we're just about there. We also have this gap right here. So if price comes down and fills that gap, somewhere around a little above 62.50, say 63, filling that gap would be a reasonable place to expect some kind of rebound. Does it keep going down and hit that long-term mean line? Possibly. Same kind of thing as the S fund. Can we come up to 50 RSI, back down to oversold, and then go higher? And we go higher from here on the I fund? It's a possibility. The biggest thing right now in the long term for all these is that this median line holds. Because if we lose that median line, again, it's a much different conversation. F fund chart looks a little bit busy, and I didn't really like putting it on a 10-year, but I wanted to keep it consistent with the other ones. Again, we have this mean trend line from back here in 2013 to the bottom in 2018, and it extends out. Then I did a shorter term from the breakout in 2018 to COVID and extended that line and overlaid it with the Fibonacci retracement levels. And we talked about it for the last couple of weeks. This was a great point that we could have seen support for the F fund. Unfortunately, we did not see support, and we're going to talk about that in a second on the 2-year weekly charts. Okay. Bonus chart. Last week we did DFEN. It's a ultra, basically aerospace and defense ETF. It's got companies like Raytheon, Lockheed, L3, Grumman. It's all the big defense contracting companies. And I bought some of it on the breakout here last week. So, like I said last week, why would we buy it on the breakout? Back here, if we connect to the tops, had a huge gap up, and it ran higher, right? So that's what we're kind of looking for, is some kind of consolidation and a big breakout. So most recently we had this consolidation, connect the tops, we had the breakout, and then the very next week the market rolled over and the breakout failed, right? So I say it failed. It came down and got below that trend line, which is not good. But it did, looks like, at least for the time being, it got support at the 20-week exponential moving average line. And we're still above that 50 RSI line. So for me personally, since I bought this, I'm still in this trade. It was down almost 10% for the week. So, if I'm looking at my account, which I don't do, the value of my account, it's down 10%, the amount that I bought of this. I'm not too worried about it right now, mostly because you have this whole series of higher lows, right? The market was definitely putting in a base down here. So as long as these higher lows continue, can we do something like this? Absolutely. So for the time being, I'm still in this trade, and I just wanted to kind of point it out back to TSP. Ordinarily, you get some kind of base like this, right? You don't tend to get a V bottom, a crash here, and it goes straight back up like that. It doesn't tend to work that way. It needs to kind of consolidate the gains and losses, and this is the consolidation. So you can see back here, volume is starting to increase relative to the volume back here. So there's a lot more trading going on in here. And as long as we can maintain higher lows, it keeps going up. At some point, I would have to do the closing prices rather than the candlestick charts, but we have, say, the closing prices like that. If we get down here below, if we undercut the lows of the closing prices, I'd probably get out of it. Okay. TSP Fund Charts. So we've been talking about this chart for quite a while. It's the 2-year weekly of the C Fund, with the blue line is the 20-week exponential moving average line. Every time after we got back above this line from the COVID low, every time we tested it, we got support, right? Until January, when price crashed through that 20-week exponential moving average line, and it has not been able to get back above it since. So until price can get back above that 20-week exponential moving average line, there's just no hope for a sustained rally, right? At some point, price is going to get, so if the line continues down, at some point, price will break out and get above that line. That's the first best chance that it keeps moving higher. So we're definitely not trying to catch the bottom, right? We're not trying to time the market to see how low can it go, and can we catch the bottom. That is definitely not what we're trying to do. We're trying to see when the bottom gets to be in place, and then it breaks out, and we'll know it broke out when it gets above that 20-week exponential moving average line. So we're definitely not going to get in at the bottom, right? We're not going to get this piece, but it puts us in a position where it's the risk reward is in our favor, that prices will continue higher if it gets above that 20-week exponential moving average line. It's a mouthful. And we got RSI down here that is not yet oversold, but it is below that 50 RSI line. So if it hasn't been below that 50 RSI line at all since getting back above it back here after the breakout from COVID. So you can see how important that 50 RSI line is, and the longer term, this is a weekly chart, so the longer term charts are more important. So if we can get back above that 50 RSI line and get back above the 20-week exponential moving average line, then chances are we're off and running to a new rally. But until that happens, there's no point in being in the stock funds. S Fund, same kind of thing. We got above the 50 RSI line back here, didn't get below it again until tech started really turning over here in November. And so you can see, again, the value of that 50 RSI line and the 20-week exponential moving average line, because once we got below it back here in November, tested it here, rolled over. Till we get back above that line, there's no hope for a sustained rally. I mean, price could jump a lot, right? I mean, if we get back up here to 2,000, that's from 1,800, that's quite a substantial percentage move. But until we get back above that line, again, in terms of a sustained rally, there's no hope. iFund has fallen off the cliff. A lot of that obviously is because of the war in Ukraine. Europe is a lot more at stake in that than we are here. Huge negative volume for the past few weeks. It's oversold. RSI is oversold. So in the short term, could we see a short-term bump back up? Absolutely. On a percentage basis, it could be quite a bit. But again, until we get back above that 50 RSI line and above that 20-day exponential moving average line, we're not getting a sustained rally in the iFund. F Fund. This is kind of a zoomed in picture from the one that we had before, but we get the same Fibonacci retracement levels, and this is kind of the most interesting thing here. We had this huge breakout last week, and it immediately rolled over this week. It's a classic bull trap in a bear market. So we had this level that we should have expected some support. We got support there. The market broke higher, and then immediately turned over and closed below both the longer-term trend line here and the Fibonacci retracement level at 38.2. So it was a failed breakout. That's fine. We took, if you were following our alerts, we took about a 0.75% loss in this trade, with the possibility of it continuing higher to, my expectation was up at 114 before it started rolling over again. That didn't happen, but the risk reward ratio was certainly there, and so that's how that went. Okay. I think
Questions?
that is about as much as I can tolerate for this stuff. It was a very geeky show, but hopefully
It was quick.
And it was kind of quick.
That's all right. Sometimes
Hopefully,
it's just that way.
Yeah. Hopefully you guys got some value out of it. It's going to be a really interesting week. Likely to be really, really volatile, right? Some people think the Fed's going to raise rates by a quarter point. Some say raise rates by a 0.5%. Either way, let me just flip back to this real quick. It doesn't really matter. Either way, it's going to be a volatile week. So stay tuned.
All right. If you have questions, put them in the comment sections wherever you found this video. And we appreciate you guys watching. If you like it, share it with your friends. Tell them all about it. And we will see you guys next week. Have a great week.
Have a good week.
We're out of here.